Hello folks, welcome to our March 2025 Market Chats video. I'm Rodney Hathaway, Chief Investment Officer here at Waukesha State Bank. We originally planned on talking about budget deficits this month, but with all the news around President Trump's tariff policies, we've had a lot of questions from clients recently about what impact it'll have on the economy and their accounts in particular. So we're shifting gears and we're going to address the tariff situation here in the United States right now, and we'll push off the budget deficit discussion for next month. Instead of tracking every tariff policy that's announced day in and day out by the administration, we're going to take a step back and look at the history of tariffs here in the United States. The Tariff Act of 1789, backed by Alexander Hamilton, was one of the first laws passed to protect the burgeoning manufacturing sector here in the U.S. For most of the 19th century, the average tariff imposed by the U.S. on foreign goods was around 20%. Tariffs were controversial back then too. However, it became a very important source of revenue for the federal government. In fact, it comprised about 90% of total revenues taken in by the government for the better part of 200 years. Post-Civil War, tariffs were raised even higher to the 50% level. However, the adoption of the income tax in 1913 obviated the need for tariffs as a revenue source, and so their use declined significantly after that point. Additionally, during the early 20th century, economists espoused the doctrine of competitive advantage, which argued that countries should do what they do best and then trade with partners for things that they don't make domestically. Also, by the 1950s, there was a wide-held belief that American companies had become very competitive compared to their international counterparts, and so there wasn't much need for tariffs on the trade front. But suffice it to say, tariffs have been a significant part of U.S. foreign trade policy for most of our existence. It's only been in the last 50 to 60 years where trade has been relatively unburdened by tariffs. Fast forward to the year 2001, when China was admitted to the World Trade Organization, or the WTO. This was championed by President Bill Clinton at the time. The WTO is the organization that sets the rules for international trade, and it was created in 1995. But its precursor, the General Agreement on Tariffs and Trade, was established in 1947. President Clinton hoped that acceptance into the WTO would galvanize China's move towards a free market economy and away from the socialist planned system, and eventually lead to the country becoming a free democracy. Two key stipulations for China's acceptance into the WTO was for them to lower tariffs and to protect intellectual property rights. Prior to Trump's first term, China had an 8% tariff on average for U.S. goods coming into China, while we had a paltry 3% tariff on Chinese goods. I imagine this chart is what President Trump was looking at when he first took office in 2017, which shows the U.S. trade deficit with China exploded after they joined the WTO. The trade deficit peaked at about $418 billion in 2018, at which time President Trump slapped about a 20% tariff on Chinese goods. Since then, that deficit has moderated a bit and was $295 billion last year. Over the past 25 years, the pros and cons of China's WTO membership has been mixed. The pros have been American consumers have benefited from cheap prices on Chinese goods. A handful of American companies have benefited from selling products into the Chinese market. Hundreds of millions of Chinese citizens were able to pull themselves out of poverty by participating in this industrial revolution. The cons have been, on the other hand, Chinese manufacturing practices have skirted WTO regulations and have added abundantly to global air and water pollution. Vast amounts of intellectual property have been stolen from American and European companies. Over the past decade, the U.S. trade deficit with China has ranged roughly between $300 billion and $400 billion per year. But most importantly, it is estimated that the U.S. has lost approximately 4 million manufacturing jobs to China during this time period. What we'd like to do now is try to put Trump's trade policy and tariff policy into perspective. Implementation of tariffs will undoubtedly raise prices for American consumers. That's the near-term pain. They raise prices on imported goods, but we believe the potential long-term gain will offset this pain. If you look in dollar terms, those 4 million manufacturing jobs that shifted to China, that equates to about $250 billion per year in lost wages for American workers. That shift in wealth has had a devastating economic impact on middle-class America over the past 30 years. Can tariffs reverse that wealth transfer? We believe this is the strategic goal behind President Trump's tariff policy. Take, for example, that same day the Trump tariffs took effect earlier this month, Honda announced they would build 210,000 Civic hybrids here in Indiana starting in 2027. Honda was originally planning on building those Honda Civics in Mexico, but shifted course due to President Trump's tariff policy. Will it be more expensive for Honda to build in Indiana versus Mexico? Of course, to the tune of roughly $1,200 per vehicle, as illustrated in this analysis done by the Center for Automotive Research. It's difficult to say how much of that incremental cost Honda will push off to the buyer, but let's just assume for the moment that they will raise the sticker price by the full $1,200. Multiply that $1,200 by 210,000 units per year, and you get a total economic headwind of approximately $250 million per year. So in other words, for the consumers buying those more expensive Honda Civics, they will be $250 million poorer. But here's the upside. An auto plant producing 200,000 cars per year will need to hire around 10,000 workers, with an average wage of about $30 an hour or $60,000 per year. These are good manufacturing jobs with benefits. If you multiply that 10,000 workforce by their $60,000 a year wage, you get a $600 million annual economic tailwind or value creation. Compare this $600 million economic value add to the $250 million headwind due to the higher cost of manufacturing in Indiana, and you get a net positive of about $350 million per year. We believe this equation will help to eliminate the wealth disparity that has occurred over the past several decades and restore the strength of middle-class America. But Americans should understand we need to be willing to accept a little bit of near-term pain in order to reap the rewards of that long-term gain. We have become addicted to cheap prices on Chinese goods for so long, but it's come at the expense of sacrificing millions of good manufacturing jobs to China, as well as diminishing our standard of living here. It's hard to say how many of those 4 million jobs that were lost we'll be able to reshore back to America, but let's just say we can restore half or 2 million of them. It could potentially add $120 billion per year in economic value just in terms of worker income. With some good fortune, we might be able to restore all 4 million lost jobs. If we were to do that, it would eliminate our trade deficit with China. The back and forth of trade negotiations has added volatility to the stock market over the past month and has caused a fair amount of anxiety with investors. But we believe the U.S. will be on much firmer footing with a strong manufacturing base rebuilt here. Again, as usual, we welcome any discussion or questions you may have on this topic or any future topics we may broadcast. But thank you for tuning in, and we'll look forward to speaking with you next month.